Why the Indian rupee falls. When you see USD INR hitting rupees 90, 89 or rupees 91, it raises a common worry. What's happening to India's economy? Today we take a deep dive into the reasons with up-to-date numbers and see why it's not just about the rupee, it's about a global and structural economic story. What rupee falling actually means. When we say rupee is falling, it means you need more rupees to buy $1. For example, 1 USD used to equal maybe rupees 70 in earlier years, now it's around rupees 90. If you import something costing USD 100, earlier that might have cost rupees 7,000, now it costs around rupees 9,000. That extra rupees 2,000 or more comes from rupee depreciation. So the same dollar price thing becomes costlier in rupee terms. This shift affects imports, become more expensive, cost of everyday items, cost for students going abroad, foreign travel, foreign services, businesses needing dollar-denominated materials. Demand supply of dollars. The core reason. Currencies behave like any other commodity. Their value depends on demand and supply. For India, when India imports goods or oil or pays foreign debt, we actually need dollars. If demand for dollars rises, more imports, oil, debt repayment, but supply doesn't keep up, dollar becomes scarcer, people pay more rupees to get dollars, rupee weakens. Because India imports a lot, including oil, electronics, machinery, demand for dollars remains high, which keeps pressure on the rupee. Oil and import dependency. Significant pressure. India imports a large portion of its crude oil and many other goods. When global oil prices rise, India needs more dollars to buy the same amount of oil. Suppose previously oil import bill required $1,000, that is rupees 90,000 now, instead of earlier maybe a lower rupee amount. This greater demand for dollars weakens INR, making imports pricier in rupee terms, raising inflation, cost of fuel, goods, etc. Thus, oil price shocks or global commodity inflation often translate into rupee weakness plus domestic price rise. Foreign capital outflows, FII or FDI withdrawals. Another big factor. When foreign investors take money out of India, that is, sell shares, bonds, investments, and move to safer assets elsewhere, like US bonds, dollar assets, what happens then? They convert their Indian rupee holdings into USD, increasing demand for USD. More demand for USD equals more pressure on INR. Rupee weakens. Global uncertainties, recession fears, geopolitical tensions, interest rate changes abroad often trigger these outflows, leading to sudden rupee depreciation. Global US interest rates and strength of the dollar. Because INR is compared to USD, the global reserve currency, what happens in the US matters for INR. When Federal Reserve, that is Fed, raises interest rates, USD-based assets become more attractive. Investors move money into USD-denominated assets, demand for USD rises, that global demand pushes up USD value. INR falls in comparison, you need more rupees to chase the stronger dollar. So even if India's economy is doing okay internally, external global monetary conditions greatly impact the rupee. Trade deficit and import-export imbalance. India often imports more than it exports. This creates a trade deficit. For example, if India imports $70 billion worth of goods but exports only $40 billion, there is a net need of $30 billion. To pay for that $30 billion, India needs to supply rupees and demand dollars, driving up dollar demand, weakening INR. This structural trade imbalance keeps steady downward pressure on the currency over time. Inflation, domestic prices and competitiveness. If inflation in India is higher than in countries like the US, Indian goods become relatively more expensive for foreign buyers. That reduces export demand. Less export revenue, fewer dollars coming into India. Combined with high import demand, net dollar demand rises, rupee weakens. Also, costlier imports due to weak rupee fuel domestic inflation, a vicious cycle. global uncertainty, and safe haven dollar phenomenon. In times of global instability, geopolitical tensions, global economic slowdown, market crashes, investors around the world flock to safe assets, often the US dollar and USD denominated assets. This risk-off sentiment means more demand for dollars, less for developing country currencies like INR. Rupee falls. Examples of such global triggers are commodity shocks, wars, global supply chain disruptions, global economic slowdown. Recent context 2025. Why INR is at around rupees 90. As of December 2025, 1 USD trades around rupees 90. This depreciation reflects persistent global demand for USD, India's ongoing imports and trade deficit pressures, foreign capital outflows amid global uncertainty, and strengthening USD globally due to higher US interest rates. Even though India's GDP growth remains strong, external and structural pressures dominate the currency movement. Is a falling rupee always bad? The silver lining. A weaker rupee isn't always negative. There are potential benefits. Indian exports become cheaper internationally, may boost export-oriented industries. Indian IT services, software exports, remittances from abroad yield more rupees per dollar earned. For foreign buyers, Indian goods become cheaper could improve demand for Made in India. But rapid or sustained depreciation can harm everyday consumers. Imports, inflation, cost of living go up. What can Reserve Bank of India do? The central bank has several tools to support the rupee. Sell foreign exchange, that is dollar reserves. Increase dollar supply, support the rupee. Use monetary policy, interest rates, liquidity to regulate currency flows. Manage import-export regulations, encourage exports, foreign investments. However, in a globalized economy, such interventions often only contain volatility, not change the overall trend if external pressures remain high. Conclusion. So in short, the rupee falls because of a mix of global and structural factors, not just domestic issues. High global demand for dollars, oil imports, trade deficits, foreign outflows, global interest rates, shifts, inflation, and global uncertainty all pull the rupee down. Right now, 2025, with 1 USD approximately rupees 90, these pressures are visible. A falling rupee doesn't necessarily mean India's economy is weak, but it does mean that India's connectivity with global markets makes it vulnerable to global winds.